once again. Thank you very much once again for joining us in this session. This is the second episode. Rather, in this journey, we are taking on together as a team to bring you market analysis and to share expertise and education on the field of trading, so to speak. And now, just very quickly, now to move on so that we can get right on it as quickly as possible. We hope now you understand the dynamics of the FX market with regard to the disclosures, the risks which are inherent in the business, and as well as the opportunities which come along with it. And hopefully during this course we'll be able to highlight that and how we can also capitalize on the same. Now just moving forward, and before I do that again, just allow me to reiterate the importance of going through the disclaimer, trying to remind you that we are not offering you, we're not giving you buy or sell recommendations here in this course, but rather we're just sharing expertise and ways in which you can be able to develop as a trader, as an individual, to help you navigate this murky waters much better. All right. Yes, so now to this slide. Our main aim, our main agenda, and this short lesson will be the market structure. As I may have mentioned, that the market structure is the basic fundamental idea. This is the pivot point of your whole education when it comes to trading any financial market, whether it is commodities, whether it's forex, whether it is the stocks, the indices, you can name it. But because it all comes down to price action, which is represented on the charts, as you can see, just as an example, I put here on the bottom right hand corner a bull market, a bullish candle, which I highlighted in blue, and a bearish candle which is highlighted in red. But basically these candlesticks, each of them represent price dynamics, price structures, which can which happen during the day. So of course there's the high of the day, the low of the day, the opening and the close on each one of them, and this could represent different periods of time. So we'll take an example, a simple one, just to be able to assume that these are daily candles. All right, so apart from that, without diverting much from the core objective of this lesson, so just real quick, I know you can read, but I'll read this real quick for you. By definition, it's simply the underlying patterns or formation which are almost mechanical, in nature, so in the markets, which are represented by price. So this is what like market structure is, if you could define it in simple terms. So just the underlying pattern or a formation which the market seems to be following. There's always a path to something, so to speak, and patterns repeat themselves, whether in the markets, whether in life. And because the markets ideally represent the thoughts, the psychological thoughts or decision making patterns between traders and the transactions and the whole complexity around it. We analyze the market because it tends to display some very similar repetitive patterns, and this what we want to try and capitalize on. We try to study and make informed decisions based on this. So understanding the market structure is key to analyzing or rather being prospectively successful or profitable in this business or any other business, so to speak. And understanding the fundamentals, that is the right term, the fundamentals of a specific business, a specific market, or whichever endeavor which is, because patterns tend to develop and to repeat rather, but because of this information we're able to make decisions, whether risk-based or otherwise. Okay, so but first, the fundamentals to all this. To form a pattern or structure, there has to be individual components to it, which we will call the daily price action, as I just mentioned. So, and of course, the daily price action is the opening, the closing, the low, price of the day, the high. And I want you to think of this as learning a new language. So if you're going to learn a new language, the first steps would be to learn the alphabets. What are the alphabets of the specific language you're trying to learn? If it was coding, for example, maybe you want to learn maybe Linux, it has its basic fundamentals. If you want to learn Spanish, of course you'd go and learn the Spanish alphabets, and then one by one you can be able to combine these individual letters to form a word. And for you to be able to form a word, that progressively makes you to be able to form a sentence. And now if you can form a sentence and read the sentence, maybe in a paragraph, you can be able to understand a story which is being narrated to you or being portrayed, say, in an article, for example. So think of the market the same way, okay? And we want to think of the market the same way because we want to really underline or understand the underlying factors, the underlying elements that makes the market move the way it moves, and what does it look like. So that is the market structure. How is this market structured? How is the market structured? What is repetitive? What is dominant? And the kind of cycles we expect, and thereon, so on and so forth. So this leads us to the first two terms which we would learn here in this short lesson. We will define a short-term market low and a short-term market high, and this we will use this as our building blocks. So let's take the long-term, the short and the long-term market lows and market highs as our alphabets, as our letters, all right, in this language which we're trying to understand here. So I'll just highlight it from here. If you look at my cursor on the right side, where you see this bullish and bearish candle, if you look at my cursor, now it's pointing at a high. This is a shadow of the candlestick. And okay, well, I'll just real quick explain this. This is called a real body. This is where the price action actually is. This is the core dealing of the day. This is where the market dealt most of its time. And for a bullish candle like this one, the blue one, where you see the cursor right now, that is the opening price. That is where the price opened for the day. Coming back a little bit higher, coming back a little bit higher, okay, coming back a little bit higher, you'll see this is the closing price, that is the high of the day, and below here is the low of the day. Same thing with the bearish candle. This was the opening, and below here this is the close of the day. So the opening and the close shows the body of the candle, all right, but the high and the low are a bit dynamic, because you see there's a long shadow on the bearish candle, and this shows where price was during the day. See, price traded all the way down here, you can see my cursor, and then came back to close the day right there. So basically that is the opening, the high, the low of the day. But what do we define as a short-term market low, and or a short-term market high? So we define a short-term market low as a low which has two preceding and two preceding lows which are higher than the low or the low in the low in question, and two lows forming after this specific low, but which are higher lows. You'll be able to see this, you'll be able to see it more graphical and much better understood, all right, and pictorially rather. So thank you for watching this, and I will thank you for watching this, and we'll move on to the next slide to be able to define our next terms. So now to the short-term low. The short-term low is it depicts the pristine image. So this, as you can see here on the right hand side, this now shows what I was trying to define. You see, we have two higher lows. This is a low here, this is a low. Two higher lows on the left, and two higher lows on to the right, and this is the low in question. So this, we define this as a short-term low. Other traders would like to define it only with 2 periods, or maybe they won't use five periods as we're doing here. Some will only use 3. If there's a low lower than the one on the left and the one on the right, they'll define that as a short-term low. So it's totally subjective, but I like to use 5 periods for me, so that's fine. As you can see, so it depicts this is a low, an image of a well-formed structure of price action, which is a pivot low, so having 2 higher lows forming on either side of it. So let's call it a down fractal for simplicity, because other traders like Dr. Williams, yes, Dr. Williams calls it the fractal. But then again, that is a whole new ground for debate. Other traders don't specifically define a fractal as Bill Williams does, but anyway, it is what it is. And now just real quick to the psychology and information behind it. So for this low to form, it means for this pattern to form, basically it doesn't mean that now price has started to rally back, that the trend has changed. No, this simply means that maybe the price, the bearish strength is starting to weaken, or maybe just profit taking, which is causing the the short-term rally, but of course evidenced by the two other following sessions which are coming after this low, this and this. So this low defines as a short-term low once you have this formation, individual formation. Now for the short-term high, it's going to be the opposite actually. It's just a mirror image of this. So as you can see, it is a high, accompanied with two lower highs. So you have two lower highs on the left and you have two lower highs to the right. And again, as we defined in the short-term low, this also just depicts not a change in the trend. Okay, we cannot jump into that conclusion immediately, but we can take this as a possible change of behavior of the underlying trend. So if the trend was going up and we had this formation here, so we would say that okay, maybe now the bulls are getting weak, or this is just a slowdown, maybe it's profit taking for the bulls, and maybe price will continue, but this is going to be a level which I would call not exactly a key level, but a level of we would expect price to respect this, to deal maybe in this range before maybe moving further or totally now reversing altogether. So thank you, and I will definitely we can definitely now move on to the next slide. So for the intermediate highs and lows, and in this slide or lesson, I will just keep it short and simple and go straight to the point. But we'll do this on our next video. So make sure that you're there, you've watched up to this point, and and looking forward to join us on this next lesson for this week. So thank you.